Gold and silver markets are experiencing a significant rally, driven by expectations of Federal Reserve interest rate cuts and heightened demand for safe haven assets. Amid global economic uncertainties, silver has surpassed the $40 per ounce mark for the first time since 2011, while gold is trading just below its record high at approximately $3,471.31 per ounce. This upswing is fueled by anticipation of a more accommodative monetary policy by the U.S. Central Bank, amidst signs of a weakening labor market and geopolitical tensions. The rally in precious metals is further supported by a recent U.S. Federal Appeals Court ruling that deemed most of Trump's tariffs illegal, adding complexity to global trade dynamics and influencing market behavior. The weakening U.S. dollar and increased investor interest in silver-backed exchange-traded funds, ETFs, have also contributed to the metal's performance. Analysts, including those from Morgan Stanley, predict further upside potential for gold, with persistent market tightness reflected in elevated lease rates, indicating strong demand and limited supply. In European markets, trading was subdued due to the Labor Day holiday in the U.S. and Canada, but the euro and New Zealand dollar showed modest gains. European equities experienced slight increases, while oil prices rose, reflecting cautious optimism in energy markets. Market participants are now awaiting the U.S. labor market report due on Friday, which is expected to provide insights into the economic recovery and potentially influence the Federal Reserve's future monetary policy decisions.
Goldman Sachs has identified a list of top technology stocks to buy, highlighting the continued dominance and potential growth within the U.S. technology sector. As of late August 2025, both the S&P 500 and the Nasdaq Composite reached record highs, driven largely by investments in artificial intelligence, AI, and related technologies. The Magnificent Seven mega-cap tech firms now account for an unprecedented 34% of the S&P 500's market value, signaling a significant concentration risk. Despite this, Goldman Sachs remains cautiously optimistic, suggesting that the robust earnings of tech giants indicate further momentum in the sector. Among the highlighted stocks, Micron Technology and Nasdaq, MU, and Accenture plc, NYSE, ACN are notable mentions. Micron is praised for its strong position in the high-bandwidth memory HBM market, with Cantor Fitzgerald maintaining an overweight rating and a $155 price target. Micron's competitive edge lies in its performance efficiency and stable supply, crucial as the market transitions to more advanced HBM technologies. Meanwhile, Accenture's strategic acquisition of NeuroFlash aims to bolster its capabilities in Salesforce and generative AI solutions, potentially expanding its market reach and accelerating the deployment of intelligent solutions globally. These strategic moves by both companies underscore the evolving landscape of the tech industry, with significant implications for market dynamics and investor strategies.
The recent downturn in stock markets can be attributed to a combination of mixed corporate earnings reports and concerns over inflation and interest rates. Major stock indexes have dipped following the release of earnings from key retailers such as Bath & Body Works and Best Buy, which struggled to meet revenue expectations. Conversely, tech companies like Autodesk have performed well, boosting their stock prices with positive earnings and optimistic future outlooks. However, Marvell Technology experienced a significant drop after its revenue fell short of analyst expectations, highlighting the volatility and high stakes in tech sector performance. Inflation remains a critical concern, with the latest personal consumption expenditures (PCE) report indicating that core inflation is still above the Federal Reserve's target. This persistent inflationary pressure keeps the market on edge about potential interest rate moves by the Fed. Investors are particularly cautious as they await upcoming economic data, including jobs reports, which could influence the Fed's monetary policy decisions. The uncertainty surrounding these factors has contributed to the recent market fluctuations, with investors closely monitoring the Fed's communications for any indications of future rate adjustments. Globally, the economic landscape is also impacting market sentiment. While some European stocks show potential for gains, concerns over European bonds present a risk that could affect broader market stability. Additionally, geopolitical events, such as meetings involving major world leaders, continue to influence energy markets, although oil prices have remained relatively stable for now. As investors navigate these complexities, Understanding the interplay between domestic and international market dynamics remains crucial for making informed financial decisions.
Paloma Partners Management Company has significantly reduced its stake in DraftKings Inc., NASDAQ, DKNG, selling 1,747,826 shares, which accounts for a 91.7% decrease in its holdings during the first quarter of 2025. This divestment leaves Paloma Partners with 158,596 shares valued at approximately $5.27 million. The move comes amidst a broader trend of insider selling at DraftKings, with notable transactions including sales by director Ryan R. Moore and CFO Alan Wayne Ellingson. These insider activities have seen a significant reduction in personal holdings, potentially impacting market sentiment regarding the company's stock. Despite these large-scale sales, DraftKings continues to receive positive attention from analysts. The company recently reported a robust quarterly performance, with earnings per share, EPS, of 30 cents, surpassing analysts' expectations of 16 cents. Revenue also saw a substantial year-over-year increase of 36.9%, reaching $1.51 billion. Analysts maintain a generally optimistic outlook on DraftKings, with a consensus moderate buy rating and a price target of $54.50. The company's strategic focus on expanding its digital sports entertainment and gaming operations, both domestically and internationally, supports this positive sentiment. DraftKings stock opened at $47.98 on Monday, reflecting a solid market capitalization of $42.68 billion. The firm's financial ratios, such as a current and quick ratio of 1.34 and a debt-to-equity ratio of 1.82, indicate a stable financial position despite a negative return on equity and net margin. The company's performance and strategic initiatives in the digital sports and gaming sectors position it well for future growth, although the insider selling trend may warrant investor caution.
The recent imposition of tariffs by Donald Trump on African imports has prompted a strategic pivot in trade relations between Uganda and Kenya. While the U.S. tariffs range from 10% to as high as 50% on imports from various African nations, Kenya and Uganda have chosen to deepen their bilateral trade ties instead of retaliating. This move comes as a response to the volatile global trade environment and aims to boost regional economic resilience. The two countries are actively working to eliminate non-tariff barriers, NTBs, that have historically hindered cross-border trade, such as reclassifying goods as transfers rather than imports and improving border operations. The collaboration between Kenya and Uganda is particularly significant given their existing strong trade relationship, with Uganda being Kenya's largest commercial partner and a major user of the Mombasa port. In 2024, Uganda accounted for 65.6% of Kenya's total transit volume. The recent agreements focus on reducing logistical inefficiencies, such as border congestion, and eliminating discriminatory tariffs, which are expected to lower the cost of doing business and enhance trade flow. This strategic alignment not only strengthens regional ties, but also positions both countries to better withstand external economic pressures, highlighting a proactive regional approach to global trade challenges.
Comtech Telecommunications, NASDAQ CMTL, and AST SpaceMobile, NASDAQ ASTS, are under financial scrutiny as analysts compare their market positions and potential for growth. Comtech, which specializes in next-generation telecommunication solutions, particularly in satellite communications, shows a stronger consensus rating with a potential upside of 207.69%, according to MarketBeat.com. In contrast, AST SpaceMobile, known for its space-based cellular broadband network, is projected to have a slight downside of 1.07%. Comtech's stronger institutional ownership and higher revenue figures position it favorably against AST SpaceMobile, despite both companies reporting negative earnings. AST SpaceMobile's stock demonstrates higher volatility, with a beta of 2.43 compared to Comtech's 1.28, suggesting greater price fluctuations relative to the S&P 500. While AST SpaceMobile trades at a lower price-to-earnings ratio, indicating affordability, its substantial negative margins and return metrics highlight ongoing financial challenges. Comtech, with its broader product offerings and strategic focus on satellite and terrestrial networks, appears better poised for recovery and growth, as reflected in its stock ratings and institutional backing. This financial analysis underscores the importance of evaluating both quantitative metrics and strategic positioning in assessing investment opportunities in the tech space.
Spirit AeroSystems Holdings, Inc., NYSE has seen a notable increase in institutional investment, with TIG Advisors LLC raising its stake by 18.3% in the first quarter, now holding $70.89 million worth of shares. This move makes Spirit AeroSystems the sixth largest holding in TIG's portfolio. The aerospace company, which specializes in aerostructures, is a significant player in the commercial, defense, and space sectors. Other institutional investors, including Royal Bank of Canada and Quarry LP, have also increased their positions, indicating strong institutional confidence, with 93.59% of the stock owned by such investors. Despite this institutional interest, Spirit AeroSystems has faced challenges, reporting a quarterly loss with an EPS of $3.34, significantly missing the consensus estimate. The company's revenue, however, rose by 9.6% year-over-year, reaching $1.64 billion. Analysts have mixed ratings on the stock, with a consensus rating of moderate buy and a target price of $38.63. The stock currently trades at $41.63, with a market cap of $4.89 billion, and exhibits high volatility with a beta of 1.74. As Spirit AeroSystems navigates its financial hurdles, its strategic focus on expanding its commercial and defense segments will be crucial for future performance.
HubSpot Inc., NYSE Hubs, has seen a notable increase in institutional investment, with Paloma Partners Management Company significantly boosting its stake by 74.8% during the first quarter, now holding shares valued at $2.23 million. This increase in holdings reflects broader institutional interest, as 90.39% of HubSpot's stock is owned by institutional investors and hedge funds. Despite the strong institutional backing, the stock has experienced a decline, opening at $483.11, with a 52-week high of $881.13. Analysts have adjusted their price targets, with UBS Group, KeyCorp, and JP Morgan Chase & Company all lowering their targets, although maintaining an overweight rating, indicating continued confidence in the company's long-term prospects. HubSpot's recent earnings report for August 6 showed a positive earnings per share, EPS, of $2.19, surpassing expectations. The company's revenue for the quarter was $760.87 million, a 19.4% increase year-over-year, highlighting robust growth in its cloud-based CRM platform offerings. However, the negative net margin of 0.42% and the high price-to-earnings ratio suggest potential concerns regarding profitability. Insider activity also saw significant stock sales by CFO Catherine Bucher and CEO Yamini Rangan, potentially signaling differing perspectives on the company's current valuation. The market's reaction to HubSpot's performance and analyst adjustments underscores the complex dynamics at play, balancing strong growth metrics against profitability challenges and market volatility. The adjustments in stock price targets by major financial institutions reflect a recalibration of expectations, while the sustained buy ratings suggest confidence in HubSpot's strategic positioning in the CRM market.
Maverick Capital Limited has made a significant investment in Merit Medical Systems, Inc., NASDAQ, MMSI, acquiring a stake valued at approximately $134.52 million, or 1,272,511 shares. This acquisition positions Merit Medical Systems as the 12th largest holding in Maverick Capital's portfolio, comprising about 2.4% of its total investments. Merit Medical Systems, known for its single-use medical products in the cardiovascular and endoscopy sectors, has seen a positive financial performance, with its recent quarterly earnings surpassing analyst expectations. The company reported a net income of $1.01 per share, beating the consensus estimate of 85 cents, and a 13.2% increase in quarterly revenue compared to the previous year. The investment by Maverick Capital reflects confidence in Merit Medical's growth trajectory, as evidenced by the company's strong financial metrics, including a return on equity of 15.07% and a net margin of 8.31%. Despite recent insider stock sales, institutional investors hold a commanding 99.66% of the company's shares, indicating robust institutional backing. Analysts have generally maintained a positive outlook on Merit Medical, with multiple firms assigning a buy rating and setting target prices ranging from $100 to $112, suggesting potential upside from its current trading price. This strategic investment and positive analyst sentiment could bolster Merit Medical's market position and investor confidence moving forward.
Saudi Arabia has achieved a significant milestone by surpassing its 2025 homeownership target a year ahead of schedule, with 65.4% of families now owning homes as of 2024. This achievement reflects the success of the kingdom's housing program, which is a crucial component of the broader Vision 2030 initiative aimed at diversifying the economy and improving the quality of life for Saudi citizens. Since 2016, homeownership rates have increased from 47%, underscoring the effectiveness of strategies such as accessible financing and innovative housing solutions. The program's success is also attributed to leveraging digital technologies to streamline the home buying process, ultimately enhancing citizen satisfaction, which rose to 89% in 2024. In the financial markets, Saudi Arabia's Tadawul All-Share Index experienced a slight decline, closing 0.25% lower at 10,670.56. Despite the overall market downturn, sectors such as electrical industries and Etihad Athib telecommunication posted gains, while Rabigh Refining and Petrochemical Company and Arab National Bank faced losses. In corporate news, Red Sea International Company announced plans for an IPO of its subsidiary, while Obeikan Glass Company completed an acquisition to assume full ownership of Obeikan AGC. These movements highlight ongoing corporate restructuring and strategic investments within the kingdom, reflecting a dynamic economic environment aligned with Vision 2030 goals.